Good afternoon and welcome to today's Premium Account Short Form Market Report. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, current Managing Director of Global Equity Management. I have 17 years of experience in the financial services industry as a licensed securities advisor. The format for today's presentation, we look at the macro outlook, the ASX top 50 stocks that we've been active in across our internal account and client accounts, and we look at the FY14 earnings per share growth of those particular names and conclude with a portfolio allocation and market outlook wrap up. It is a short form webinar today. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Up on screen's a graph of the XJO, and at 15 times earnings I've been chatting about the fact that our market's reasonably full value, albeit at the same time I've been highlighting that we thought that the resources were a little bit undervalued and had the potential to deliver earnings growth that exceeded analyst expectations. We've started to see the production numbers come through for the September quarter from BHP, Rio and Woodside, as well as Fortescue. Those numbers support our view, and as a consequence we've seen the index push a little bit higher through here, as predominantly as a result of these resource names starting to contribute to the market a little bit more. We are more of the view that we get to a sort of a balanced, sort of overvalued position where we are at the moment, and we do come into a consolidation period for equities. Having a quick look at just a couple of these companies that have produced their September quarter production numbers. BHP, the highlight was strong iron ore, strong coal and petroleum. From a valuation standpoint, about 12 times next year's earnings. Roughly $2.63 of earnings per share, likely for BHP to deliver in 14 on a yield of about 3.5%. I think that around $39 the stock starts to look full value. We are owners of it at lower levels. We've been patient and waiting for the stock to get up to these levels where we have a target of getting those calls set up at around $39.50. I'd expect BHP to remain reasonably buoyant sort of through November, December, and into January we'd be happy to deliver the stock with an effective exit price up at around $41 or $40.50 thereabouts into that sort of period there around January, February. Also delivering their third quarter or their September quarter production numbers with Rio marginally ahead of expectation, being a more of a single commodity stock. Rio, you don't expect it to trade on the same PE as BHP, around 10-11 times forward earnings. Our valuation for Rio sits between sort of $65 and $67. Fortescue delivered their results, certainly on track, delivering around 100 million tonnes per annum, and continuing to sort of forecast that production to expand up to around 130 million tonnes per annum, with that eventual target of 155. At around sort of $5.70 short term, start to look at Fortescue as reasonably full value. So our two preferred resource stocks still remain BHP and Woodside Petroleum. Woodside Petroleum on around a 6% dividend yield, about 8% earnings growth. The stock should be well supported at or near these levels, and we're selling covered calls up at around that $39.50, $40 level over Woodside Petroleum. The other names that we've been active in over the course of the last week has been Amcor, so we've been patient here where we bought Amcor on the dip. We've been waiting for it to rally. We've just managed to sell the 11.25 calls now into January. We've generated around 20 cents for those, so again boosting that cash flow from that sort of 4.5% dividend yield that the stock traditionally offers up to around 10% cash flow, and also allowing for some capital growth. I've spent a lot of time on Amcor from an analysis standpoint, talking about the demerger, their earnings growth, and we'll continue to revisit that in the future weekly market reviews. In addition to Amcor, we've been active over some of the property stocks that we'd bought a month or two back. We're patient over Stocklands. We're waiting for it to rally up to around this $4 level. We've sold the 4.20 calls into March. We generated around 8 cents for those, again boosting that cash flow from sort of 6% div yield that the company offers up to 10%. And I think if you take into consideration their earnings per share is only likely to grow at around somewhere between 6 to 8% over the next 12 months. They're already paying out close to 100% payout ratio. I don't see that there's a lot of scope to increase the div payout over the next 12 months. I think it's sort of 4 to 4.20 the stock's full value, so we're happy to take profit up at those levels there. The other name that we'd been patient on there was Transurban. We own it at lower levels. We've just sold the 7.25 covered calls into March. Transurban goes ex-div in December, so again boosting that cash flow up to around 10% and delivering the opportunity for some good capital growth. Hard to see that the stock supports a valuation much above 7.25. Lendlease, we've been active in Lendlease. We've seen the company reconfirm comments that they'd made only a month or two ago in their EGM this week. The comments just reassured investors that the company expects to see it return to solid growth, and the interpretation there is that they'll deliver sort of somewhere between maybe 8 to as high as sort of 14-15% earnings growth over the next 2 or 3 years. Back at around 11-12 times earnings, fair valuation for us for Lendlease is around 11.50. So we'd expect the stock to now consolidate and sort of move sideways between sort of 10.50 and really around 11.50. Also, in the market that we're starting to see perform well are a couple of these names, being Computershare, where we own it at lower levels at around 10.50. I think we start to have a view that it gets a little bit expensive. An effective exit price with a covered call up at around $11 sort of covers the story there. Brambles, we've been patient on this one as well at around 9.50. We think it starts to get a little expensive, so we own it at lower levels. We've sold the covered calls up at the higher price point there. With the AGMs coming up, we keep an eye on the AGM for Toll, which comes up on tomorrow on the 24th. But again, probably of a view that the stock's looking reasonably expensive here at these levels with about 5% earnings growth. We see fair value at around 5.50 on Stocklands, on Toll I should say. AZJ delivers its AGM on the 7th of November. The market's looking for about 20% earnings growth here out of AZJ. The stock trading about 20 times earnings, fairly expensive. We're keen to be buyers of AZJ again, but only on a pullback to around 4.50. And Wesfarmers, their AGM on the 7th of November as well, at around sort of 18-19 times forward earnings on a 4.5% dividend yield. The stock's reasonably expensive. We do own it at lower levels. We've capped it out at an effective price of around $43.50, and I think that captures the upside over the next few months for Wesfarmers. So to conclude, so we have option expiry coming up on tomorrow. And broadly, our view is that from a portfolio allocation standpoint, we still need to own the defensive names. We recognise that they're expensive. We're selling tight covered calls over them. We have some exposure to the banking stocks, being ANZ, NAB and Westpac, that will soon pay their dividend. Again, we have covered calls over those in the European style to collect both the premium and the dividend income. And the exposure to the resource names in BHP and Woodside, which have been helping to contribute to the returns, and those names are only just now starting to sort of trade up into our fair valuation range, where we'll look to sell covered calls over those. Thank you for listening in today's recording. I look forward to speaking again next week.